Thanks, Tim, and thanks everyone for your time today. I've been involved with Calima for around about 6-7 years now, and today we are in one of the strongest positions we've ever been in. If we can move to the next slide, please. Thanks. So the company's built its position in Canada. We've got 3 major assets that we have up at starting up at Brooks and Thorsby, are low decline conventional assets, and then in the Montney we have our rich wet gas. This provides us with a phenomenal energy base that can generate tremendous cash flow and is generating tremendous cash flow for the company, particularly as energy prices are ramping up. I'm not sure if everyone's had a look, but oil is now over $90 per barrel, which is quite a significant change. We acquired the Brooks and Thorsby assets back in April, and we negotiated the transaction at $40 per barrel. So it's been a big ride for us. The assets at Brooks and Thorsby are tier 1 producers. The all-in drill and completion costs are around about $26 per barrel, and our operating costs are $14 per barrel. And we currently have around about 78 wells on production. This gives us tremendous torque. So when the oil price is running, we generate significant cash flows. To date, in the last 2 months, for example, we've now drilled 4 wells at our Gemini, at our Sunburst projects out at Brooks, and we've also drilled another 3 Pisces wells at Brooks, and we've drilled a well at North Thorsby. So quite a significant progress in our first half-year drilling program. We're targeting our production around 4,000 to 5,000 BOE per day. We just announced a few days ago that our January exit production was 4,300 BOE per day. So 14 of the 24 wells that we initially planned have now been drilled, with 10 more to go for the second half of 2022. If we could move to the next slide, please. The company's current oil weighting is around about 74%, so it's quite a significant cash flow producer in the oil sector. Our revenue for the year ended 2021 was 48 million. We've got an adjusted EBITDA of 21.6 million. I'm going to run through the sensitivities for 2022 because 2021 was based on an average production of around about 3,000 BOE per day. So we've had a significant uplift in this current financial year. Capital expenditures for 2021 were 27 million, and we're anticipating our EBITDA at 31 to 37 million for the 6 months ending 30 June 2022. Quickly, our total proved, probable, and possible reserves are 25.7 million at Brooks and Thorsby. Our PDP, proved producing reserves, are 5.2 million. And our 2C contingent reserves at the Montney is 192 million barrels of oil. We can move to the next slide. Management is primarily focused in Canada. The gentlemen that are running the company, Jordan Keevil, is our managing director. He's been with the company for the last 9 years, as have most of our VPs. Which includes Braden Brousseau, who's our CFO, very experienced guys, as well as Dawn and Graham Veal. I mean, Graham's just drilled these last 7 wells on time, on budget, and they are producing quite lovely. If we can go to the next slide. It's just a quick summary of our quarterly production. In our Q4 quarter, people have commented on the reduced average production. We had our 3 Thorsby wells come on, and these were 3rd generation wells. They were the first of our 3rd generation Thorsby wells that are fracked well. The wells were substantially longer with much bigger fracks, and we had a very, very cold year end in Canada, which meant that we had a couple of the wells go down. It was difficult to get guys over to the site and to get things fixed. But everything has now been resolved, and these 3 Thorsby wells have contributed to our production quite substantially. They're producing on target, and have added an additional 1100 BOE per day to our production. As you can see, quarterly, we produced $20 million in sales. So notwithstanding our production was lower, oil price was higher. So as we're quite substantially talked to oil price, production revenue was on budget, and we had an EBITDA adjusted of around about $10 million. Next slide, please. So this is our current well progress. As you can see, a very, very busy half year. The two Pisces wells are in our Brooks area. They are both fracked wells. They came on production at the end of January and have come on quite strongly. Very, very satisfied with the results there. And then we've got 4 new wells that are in our Brooks area, which is the Pisces 3, Gemini 5, 6, and 7. These wells are going to be tied into a new pipeline that we're currently laying down at the moment, and are going to help us go from that 4,300, and we're anticipating 4,000 to 5,000 BOE per day average for the half year. As you can see, our Leo wells are only going to hit their IP90s in mid-February and in March. And then additionally, down the bottom, we've got our Leo number 4 well. We drilled this well in January, and it's up in the north of the Thorsby area. It's in an expansion area. We haven't drilled here before. We're hoping this well, we've got a 50% interest in this well, and we're hoping this well will create a significant uplift in our reserve base. In addition to that, we've got our waterflood expansion that we're continuing to develop, and I'll run through that shortly. Next slide, please. So these are our sensitivities. At $80 per barrel, we're expecting for the 6 months to the end of 30 June, gross revenues of 55 to 66 million, with adjusted EBITDA between 31 to 37 million Aussie. So you're going to take into consideration that's for the 6-month period, and we're sitting with a market cap of 120 million. So, if you can do the math yourself, and you're looking at it, a 2-to-1 ratio, which is substantially low and very low in our industry. As we see on the far right, where oil's hitting $90 per barrel, we're looking at revenue of up to 74 million for the half year, with adjusted EBITDA between 36 to 45 million. So again, quite significant production netbacks. Next slide, please. Quickly going to run through, conscious of time, quickly going to run through our Brooks area. As you can see on the map, those are the wells that we've drilled since acquiring the asset. So Gemini 1 through 7. Most of those wells were drilled within our core area, and we've got one step-out well, which is Gemini number 4. We have over 12.9 million barrels of reserves 3P within this area. We've got 130 net locations, and of that, 30.5 of them are actually what's booked in our reserves. So 4 wells were drilled back in June, July. Those wells, Geminis 1 through 4, have actually made their money back already and then some. So that's the beauty of these particular wells. They're not a fracked well, they're a conventional well. They go down, they drill horizontal. They cost about 1.2 million to drill, and they go on production very quickly. And payback is 5 to 6 months. Next slide, please. The January production for Brooks was around about 2450. Exit IRRs are at $70 a barrel, 400%. At $80 a barrel, they're 500% on the Sunburst wells. On the column second from the right on the table, what we're showing there are our Glauc wells. So these are the Pisces 1, 2, and 3 wells that I mentioned earlier. We're very happy with the production that we're seeing to date on the Pisces wells. One of the Pisces wells is double the length and And so far to date, double the production flow rate. So very excited to see how they go. Next slide, please. This is our pipeline project. As you can see in the dotted green lines sitting between Gemini 7 and our Pisces 1 up the top north, that's the pipeline that we're laying down. And the dotted red lines are essentially the wells that we're planning on drilling in the second half of this year, this calendar year. This pipeline provides a significant uplift for the company. We managed to secure a facility which is now costing us around about $76,000 per month in respect of paying for the pipeline. It's going to save us immediately around about $55,000 in haulage costs, which is quite substantial for the company. In addition to that, we've got significant operating cost reductions. So management anticipate that the cost of laying the pipeline is actually going to be immediately offset by the current operating costs in actually trucking the oil around. It's also had a significant uplift in our ability to increase the economics on all the wells within that pipeline. And in addition to that, the ESG benefits are quite substantial, taking all those trucks off the road. Next slide, please. This is an overview of our waterflood expansion. I'm going to quickly move to the next slide, please. THORSBY production is at 1830 per BOE. The 3 wells that I mentioned previously have come on and they're going to hit their IP30s in mid-February/March. Very, very happy with the production to date. And as you can see, we've got additional PUDs on the map, quite a lot of PUDs within our core THORSBY area that we'll be working towards developing. And in addition to that, to the further north is our step out Leo number 4 well. Next slide, please. The THORSBY economics are significant. As you can see, the right column is our multi-stage. This is generation 3 economics. Over 500% rate of return, paybacks within 5 months at $70 oil. We're now sitting at $90 oil. As you can imagine, the economics are quite significant at that rate. Next slide, thanks. This is our footprint in the Montney. The Montney is up in British Columbia. We've got contingent resources set out down the bottom of around about 200 million. It is a 10-year license that we have in place, which expires in 2029. We don't have to spend any more money to maintain those leases. We've acquired a facility to the north, which is the Tommy Lakes pipeline and facilities plant. It's an $85 million replacement cost. To go from our existing wells to that facility will cost us around about 12 to 15 million. It's you know, at $4, $5 gas, it does make money. It's a significant investment. We're currently looking at ways of unlocking value with a strategic partner. Next slide, thanks. The slide runs through all the recent sales within the region. There are a lot of big companies that are making very big acquisitions. The most recent was Cenovus. This month sold their Montney acreage. They were doing about 3,200 BOE per day for 238 million. To our immediate south, Black Swan were acquired by Tourmaline for 1.1 billion. Next slide, thanks. Overall, a quick summary of our production growth strategy. We have facilities in place that can grow us up to 10,000 BOE. We're well on our way to targeting 6,000 BOE. We've got PUDs, we've got low cost development, we have pipelines, we have facilities. The company spent over 200 million in developing its assets to date. And overall, we're in a very strong position. Thanks, Tim. I'm open to questions.
Thanks, Mark. We've got a couple of quick questions. That Cenovus transaction at 238 million, have you done the back of the envelope valuation for Calima on the back of that?
Very hard to complete those valuations. It's based on, you know, at the moment, the company, whilst we have our facilities in place, we don't have the production in place, so they don't ever tell you what it is on a reserves basis. But we're hoping to unlock quite a bit of value, obviously, on our Montney acreage. We're the last small independent company left in the region with reserves and with a facility and a short pipeline connect. So I don't want to put a dollar value, but we're obviously hoping for a significant upside for the company.
And just quickly, there's quite a few questions here, so if you don't mind, you could perhaps type some answers into these questions. Just one more question. So what's the position with debt, your cash flow and future dividends, and also how's hedging placed within the book?
So if we when we're looking, I can't go back to our slide. What we're anticipating is our debt's going to be paid back from our production. We've obviously spent up on our existing facility over this first few months to get the wells in place, and we had to do that. When you've got a high oil price, you have to lock your contractors in place or you miss out. Canada has a lot of really large companies, big guys that are willing to just put the money down, and we have to compete with those people. So we're anticipating our exit June debt numbers to be quite significantly down. Hopefully, some of our expectations for year end 31 December is that we'll be exiting at zero debt.
And just quickly, dividend policy potentially. We don't have much time, but just quickly.
Yeah, I mean, look, with this much cash flow coming in, obviously we've got to see that cash flow hit the bottom line. I'd like to see that debt get down much lower, and ultimately we'll be looking to, if we don't see a significant uptick in our share price, we'll just be most likely going in and doing a share buyback.